Imagine putting away just £500 a month and watching it snowball into almost £17 million. That's the promise behind a real share trading right now, paying a jaw-dropping dividend of around 15.3%. It sounds like the ticket to early retirement, no questions asked. Stick with me though, because the real lesson here isn't about getting rich, it's about not getting caught out. Here's the maths that gets people excited. Feed £500 a month into a share like Armour Residential, currently yielding around 15.3%, and reinvest every single dividend along the way. Assuming that eye-watering yield held perfectly steady for 40 straight years, the pot could theoretically swell to almost £17 million. That's the fantasy. Now let's see why it almost never plays out like this. Watch how this snowballs on paper. In 10 years, an assumed 15.3% return turns those contributions into around £140,000. By 20 years, it's nearing £777,000. By 30 years, past £3.6 million, and by 40 years, close to £17 million. It looks unstoppable on a chart, which is exactly what makes it so dangerous. At that point, a 15.3% yield on nearly £17 million would, in theory, pay out about £2,578,000 a year without selling a single share. It sounds like total financial freedom, done and dusted. But before anyone gets carried away, there's a giant asterisk hanging over every number we've just shown you. And that's what we need to unpack next. Before we get carried away with millionaire maths, let's pump the brakes. A yield above 15% is not normal. It's a warning light flashing on the dashboard. Armour Residential isn't a shop or a tech firm, it's a mortgage REIT, borrowing heavily to buy mortgage bonds, and that structure makes sky-high yields far more fragile than they look. Here's the number the dream doesn't mention. Over the last 5 years, Armour's share price has fallen by roughly 68%. Anyone who bought purely for that juicy dividend has watched most of their original capital disappear, even while collecting a check every month. This is where the maths turns nasty. Yield is simply the dividend divided by the share price, so when the price collapses, the yield mechanically rockets upward, even if the actual payout hasn't grown at all. A 15% yield can mean a thriving business, or it can mean a shrinking price making a shrinking dividend look enormous by comparison. Mortgage REITs, like this one, borrow money to buy mortgage-backed bonds, then pocket the gap between what they earn and what they pay to borrow. That gap gets squeezed hard when interest rates move, which is exactly what happened repeatedly over the past few years. Leverage magnifies gains on the way up, but it magnifies losses just as brutally on the way down. Dividends this large very rarely survive intact. Companies and trusts under pressure often cut the payout to preserve cash, and Armour has trimmed its dividend multiple times over the years as its book value eroded. Chasing today's headline percentage is no guarantee it exists next year, let alone in year 40 of anyone's spreadsheet. What actually matters is total return, the combination of price change plus dividends paid added together. Reinvesting a 15% yield looks incredible on a spreadsheet, but if the share price keeps sliding, those reinvested dividends are just buying more of a shrinking asset. Total return can quietly turn very unpleasant even while the income stream feels generous. Picture someone who put that same £500 a month into this single high-yield share 5 years ago, tempted by exactly the dream we opened with. Instead of a snowball, they'd have watched their pot shrink in real terms, with dividends only partly cushioning a falling share price. The income felt satisfying. The capital told a much harder story. This pattern isn't unique to one ticker. It repeats across markets whenever a yield looks too good to ignore. Energy trusts, shipping companies, and other mortgage REITs have all lured income-hungry investors with double-digit yields, only for the share price to do the heavy lifting in the wrong direction. The dividend is the bait. The price is where the damage happens. So the outrageous number from earlier wasn't wrong exactly. It just quietly assumed the impossible, that a 15.3% yield holds steady for 40 straight years with no cuts and no price collapse. Reality has already shown that assumption failing within just the last 5. Next, let's talk about what genuinely tends to build wealth instead of just promising it. So what actually works over the decades that matter? Investors who focus on total return, share price growth plus dividends combined, tend to do far better than those chasing the single flashiest number on a screener. As a rule of thumb, the aim isn't the highest yield today, it's the highest sustainable return once everything, including any capital lost, gets added up. Quality dividend payers usually show a dividend covered comfortably by earnings, a payout ratio that leaves room to breathe, and a business that's actually growing rather than shrinking. None of this guarantees anything. Capital is always at risk, but these are the kinds of questions worth asking before a headline yield becomes the whole decision. It's due diligence, not a promise. Putting a huge chunk of savings into one single share, however tempting the yield, means one company's fortunes decide the outcome. A broad index fund spreads that same money across hundreds or thousands of businesses, so no single dividend cut or price collapse can sink the whole plan. Diversification doesn't stop losses, but it stops one bad bet from becoming the whole story. History suggests that broad, low-cost index funds, reinvesting dividends quietly for decades, tend to outperform concentrated high-yield bets more often than not. That's an assumed pattern based on the past, not a guarantee for the future, and capital remains at risk the entire time. But it's a far steadier engine for a long-term goal than hoping one ticker's dividend survives 40 years untouched. The hardest part of investing is rarely the maths. It's the discipline to keep contributing through boring, unglamorous years while other people chase the next outrageous yield. Patience, regular contributions, and ignoring shiny headline numbers is a rule of thumb that has served long-term investors well. Excitement is usually the enemy of a steady plan, not the ingredient of one. Before chasing any headline yield, it's worth asking a few quick questions. Why is this yield so much higher than similar companies? Has the share price fallen sharply lately? Is the dividend actually covered by real earnings, or is it being paid out of hope? These are educational prompts, not a personalized checklist, but they catch a lot of dividend traps before the damage is done. The dream of a snowballing income is real. Plenty of patient investors do build meaningful portfolios over decades. But the path there runs through quality, diversification, and total return, not through a single eye-catching percentage on a falling share price. Get the foundations right, and the maths from earlier in this video becomes a genuine long-term possibility rather than a fantasy. If breaking down the numbers behind big financial claims like this is useful, there's plenty more where this came from on the channel. Subscribe for more deep dives into the reality behind the headlines. All education, never personalized advice. Thanks for watching, and see you in the next one.